Hey, good morning everyone. This is Troy Eckard with Eckard Land and Acquisition. I'm going to provide you a series of working videos. Try to keep them under 10 minutes or so to basically start explaining some of the things that may or may not be at least understood by many of our partners. Now, I do realize that some of you are engineers and some of you have been in oil and gas for quite some time. In fact, some of you have been our mineral partners for almost 4 years, and you get it. You get a lot more than the new clients do, but at the same time, I can tell by the questions being asked, and I can tell by a lot of the conversations that some of you, many of you, still don't quite get the true intrinsic value of minerals, which is what drives me to invest the money that I invest by buying mineral rights in Oklahoma, Texas, and other areas that I believe are prolific with oil and gas hydrocarbons in place. So I've drawn a schematic on the board, and I'm going to just walk you through this, nothing fancy, but I want you to follow me, okay? So in Oklahoma, all of the areas of Oklahoma are divided into 1 square mile, or basically 640 acres, which is called a section of land. The oil companies will combine 2 sections of land to drill a single horizontal well. So they're going to come down and they're going to drill a well, and they're going to go down vertically into the zone that they desire to produce in. Now let me explain what this looks like. The source rock, where most of the oil and gas hydrocarbons were deposited, is in the deepest zone called the Woodford. It's the Woodford Shale. The Woodford Shale over time had a lot of earth buried on top of it, and those oil and gas molecules began to cook because of the magma in the earth in the center. It's like a boiling pot of rice. Through faults and through tectonic shifts and through all kinds of different geological events, the oil and gas percolated in the Woodford and it moved up to the surface because of the pressure of the earth pushing down. When it did, it went into the next zone, the Mississippian. It went to the next zone shallower, which is the Springer, and on and on and on. There's about 36 known productive reservoirs in the Anadarko Basin in Oklahoma. So what we do is we have looked at where the oil companies have determined the greatest value is. In many cases, the greatest value starts in the deepest zone called the Woodford. In some cases, they like the Mississippian or they may like the Springer better. Why? It just depends on the thickness of the reservoir, it depends on the production, it depends on the gas-oil ratio. But at the end of the day, almost all these zones are prevalent or present throughout the Anadarko Basin. It's just as one's better in one place than the other. I really don't care as long as I've got lots of zones and lots of reserves. I'm going to give you the end of the story so that way you know where I'm going with this. I'm going to talk to you about the greatest value that we have in minerals, which many of you are a little bit skewed in the way you're thinking. It's a great thought, but it's skewed. You're worried about lunch money. You're worried about cash flow. You're worried about, am I going to make 8%, 10%, or 20%? And all that's really, really important because it helps us with that passive income. It helps us create the cash flow that we need to make additional investments. But if I told you today you could give me $1 million, and at the end of 10 years, I could give you back $3 or $4 million, but you didn't get any cash flow for 10 years, but you were relatively confident, let's say 90% or higher, that you could end up with 2, 3, 4 times your investment, but there's no cash flow involved. Would you make the investment? Now, some of you would say, I might not. I like cash flow. Many of us who don't need the cash flow, who like growth and like significant upside to our portfolio, I park $1 million to give me back $3 or $4 million in 10 years. I don't need the money. I'll make money doing other things. So what you're dealing with here is you're dealing with a safety deposit box. Each one of these reservoirs is trapped. It's not going anywhere. You have about, 50 to 100 million mineral acres in the Anadarko Basin loaded with oil and gas. But the problem is there's only one little straw, one little well. And in this case, this well is going to go out and it's going to drill horizontally, and it's going to come down here in this nice, beautiful zone, and that's one single well producing from a 7 1/2 inch little pipe. There's only so much volume that can fit in a 7 1/2 inch pipe. So you might have 1 million, 5 million, 8 million barrels of oil equivalent in the Woodford on your 2-section horizontal producing unit. By the way, let me slow down. When they take a section, add it to another section, it's called a dual section producing unit. It is permitted, like a construction contract. I'm going to put a building here. Everything that we have is below the surface. I don't care if there's a farm, a 7-Eleven, or a gas station. Could care less what's on top. We only focus what's below the surface. So when the oil company, Oventive, Continental, Marathon, whoever it is that has leased the minerals, we're looking to see what they are doing below the ground. It's like a construction or a mining project. In this example I'm giving you, we have a 7.5-inch hole that is drilled. It goes out roughly 9,000 feet or almost 2 miles horizontally in the Woodford zone. It is cased. There's no communication from this well to any other zone because the casing prevents it from sharing one reservoir for another. There's a point to this. If I walked into my bank today and said, hey, I'd like to look at my safety deposit box, and in looking at that safety deposit box, I said, hey, I want to know what's in box number 1. Well, in box number 1 is 500,000 to 1 million barrels of oil, but I can't get to box number 2 or 3 because I don't have access to it. The oil well itself opens up the next safety deposit box in value because it takes a single well to be drilled to expose the reservoir to additional extraction of oil and gas that's in place. Now, let me give you an example of how dramatic this is because it's very important. In the northern part of the Anadarko Basin, up to the north, away from the Texas border, there's approximately 50 million barrels, 50 million barrels of oil equivalent per section. No, you heard me right. I'm not saying 5,000. I'm not saying 5 million. 50 million barrels of oil in place per section. When you add 2 sections together, this well and all the subsequent wells that are drilling are going to access the potential of 100 million barrels of oil equivalent in place. Now, there's an important definition you need to understand. When I say oil and gas in place, it doesn't mean that we can recover it all today because it has to do with technology and timing and commodity prices. What I like, though, this is one massively organically rich 2 sections of land, basically 2 square miles. And the oil companies have figured out through horizontal drilling and fracking how to get out the maximum amount of oil and gas per every single well drilled. Why? It's about economics. I'm going to go spend $10 million. I'd like to know that well can get out 1 million barrels of oil equivalent. But how many oil and gas barrels are in the Woodford, or in the Mississippi, or in the Springer? Each reservoir, each safety deposit box has its own trapped quantity. I tell you what, let me slow down because I get kind of ramped up. I want to make sure you follow me. We have a lot of trapped oil and gas reserves in the ground. Mother Nature has been incredibly generous. Deposited all this oil and gas. The core of the earth has heated it up to a boiling point. Mother Nature provides pathways called faults and plains. It moves from the shallower, the deeper depths where it's pressurized to shallow depths. In between each one of these hydrocarbon-rich reservoirs is a non-porous, non-permeable reservoir which acts like a lid. Once it traps, and it traps, and traps, it's in place. Through 120 years of developing the Anadarko Basin, the oil companies know where these zones are and what depth they are, how thick they are. So we've had 120 years of prior investment creating a map that tells us where all the oil and gas is. This is a question now of economics, capital, and manpower. 50 million barrels per section means we have 100 million barrels of oil in place at the northern part of the Anadarko Trend, in place that we, as we buy mineral acres within each one of these sections, we own our pro rata share. So let me explain to you what that does in math. If I've got a single horizontal well, and you and I, Eckard and Eckard's partners, we buy 20 acres. Okay? So let me get a different color pen here real quick. All right? Let's just say we buy 20 net mineral acres. Here's the fun part. I don't have to be in section B or section A. I just have to buy 20 acres and be underneath the 1,280 acre unit. It's called forced pooling. Because all the minerals in this 2 section share mathematically their proportionate share of the value and the reserves and the cash flow, I don't have to guess the lucky number and the lucky position to be in. I just got to be inside the unit. So if I have 20 acres, the question becomes, what does that mean? Now, a lot of our financial model to you, to most of our clients is about, I buy an acre, I buy 20 acres, what's the cash flow look like this year, next year, and in 5 years? And that's good. We got to have some kind of rate of return on our money. But I'm going to tell you, after doing this for 4 years with such great partners, if we had to do an emphasis balance, the emphasis on cash flow is here, and the emphasis on reserves is down here. Why is that? It's called immediate gratification. We like what we can see, we can touch and feel, right? Nobody plants olive trees anymore because it takes 20 years for them to grow and mature. I've got pecan trees in my house. It's 7, 8 years until I get a full canopy of pecans. I don't want to buy a pecan tree. I want to go buy a property that has pecan trees that already have fruit. The issue is, time is really an important factor, but what's more important to you and me is, for every acre I buy, how much oil and gas, like Exxon, am I capturing proportionate to the acres that I buy that goes in my safety deposit box? Now, I'm going to explain to you what this all means to me and what I'm expressing to you. At 100 million barrels of oil in place in these reservoirs, collective total 100 million barrels over 2 sections of land, okay? If I were to simply take that and divide 100 million barrels by 1,280 acres, 2 sections of land, it's about 78,125 barrels of oil equivalent for every acre that I buy. Wow, that's a lot of oil and gas. However, we don't own it all. We have leased it to Exxon or Marathon or whoever else is the operator. We've leased them the right based on a royalty agreement and a lease agreement. They're going to get the lion's share because they're going to spend all the money to extract all the oil and gas. So if we just take a good mathematical number today and say, out of the 100 million barrels, with today's technology, with today's economics, with today's expertise in extracting oil and gas, it's about an 8% recovery factor. So out of the 100 million barrels, mathematically, for every acre, I got 78,000 barrels, 125 barrels of oil equivalent that is proportionally in place to my 1 acre. But there's only an 8% recovery factor today. That recovery factor keeps going up. I mean, they're getting better and better at recovering oil. That means I've only got about 6,250 250 barrels of oil equivalent for my 1 acre. Here's the 100 million. I'm only going to get it divided by 1,280 acres, so my single acre gets basically 78,125 barrels. I only own, 8%, because that's all they can get out today, so I got 6,250 barrels of oil, which is a lot of oil and gas to my 1 acre that can be economically recoverable today. I own the rest of it. I own it forever in perpetuity. It's just a matter of when they get to it, right? Remember, horizontal drilling has only been around 12 or 13 years, so technically speaking, all this oil and gas down the Woodford wasn't even economically viable 12 years ago. That's the key thing to remember. But if I take the 6,250 barrels of oil equivalent today that's recoverable, and I multiply that times, let's say, a 3/16 royalty interest that we normally have as an average royalty in the acres that we buy in the Anadarko Basin, that's 18.75% that we keep, free ride, free income, free value reserves, that gives me about 1,172 barrels of oil equivalent net to my 1 acre I buy. Okay, that doesn't sound like right. 1,171 barrels. All right, now let's multiply that times $95 a barrel today. I'm going to use $95 oil, $8 gas, doesn't matter whichever way you go. I now have put in my safety deposit box, for every acre that I buy, I now control 1,171 barrels of oil equivalent to the 1 acre I bought using today's recovery, today's success, today's technology, out of 100 million barrels, which gives me a value of what? That's $113,000 in value today of reserves I put into my safety deposit box. Now I'm going to express this a little bit for each one of you to kind of get the final conclusion on this video. The oil companies have 100 million acres in the Anadarko Basin. I mean, it's massive in size. There's about 62 drilling rigs active in Oklahoma today. Okay, today's August the 3rd, 2022. Out of 100 million acres, those 62 drilling rigs are drilling in the best location, the highest recovery factor, the fastest recovery factor, the most reserves that can be recovered per well, and the most number of wells that can be drilled economically based on infrastructure, supply, and everything. So I've got this billion-dollar oil company that's got a checklist, and they've done all the work to say, this is the best 2 sections for our next well to be drilled. You and I, through Eckard's management and our skill and expertise, we then look at where all the best oil companies are drilling, and then we go buy 20 acres underneath this 2 section. So we're not having to guess where the best oil and gas is. We know from the 62 drilling rigs that are active, the permits that are being filed, where they're planning on drilling. We know where these billion-dollar oil companies, the smartest oil companies on the planet, have decided to drill. Now, what do we get? We're going to get the fact that when they go spend that $8 or $10 million to drill that well, they're looking to recover those dollars in less than 24 months. That's a very fast rotation. At today's prices, it's about 200,000 barrels of oil equivalent to pay out that first well. So I know the smartest companies are drilling on the best acreage where we're going to buy minerals, knowing they're going to get out 200,000 barrels of oil equivalent per well in a period of 24 months or less, which is what they've been doing. But they're not drilling one well at a time. They're drilling 3, 4, 5 wells at a time. So that tells me oil company leases and drills. They prove up the location 5, 6, 7 years ago. They come back now and they drill wells 2, 3, 4, and 5. They're looking for 200,000 barrels of oil of our 50 million barrels of reserves per second. And all they want to get out is 1 million barrels of oil equivalent to get their money paid back for the wells they drilled. So let's talk cash flow. That means you and I have an extremely high probability of getting back the minimum barrels of oil equivalent to pay back our mineral rights acquisition cost. And the remaining unbelievable 8, 10, 12 million barrels of recoverable today is sitting there waiting to be pulled out of that safety deposit box as they drill more wells, they drill upper zones, they go to different reservoirs, and they do all that free of charge to us. So here's my wrap up. It's very simple. I do not have to be a genius when it comes to understanding the oil and gas and the extraction process. I have created a team here at Eckard that represents your interest and says, let's find the most saturated minerals with the best operator with the highest recovery factor. Let's run it mathematically and say to ourselves, can we generate a 12 to 30% rate of return? Absolutely, based on 200,000 barrels in 24 months. Absolutely. What's the probability you're going to drill more wells? Why would you go anywhere else if you know you have 100 million barrels that's already proven with pipelines, electricity, roads in place? I'm not going to go to some new area to explore. I've already got barrels in place that are easily extractable at very low risk. And the third part is for you and I. The cash flow is kind of like a measuring stick. I put in $1 million in the minerals and I'm getting back this $100,000 to $150,000, $200,000 a year in return. And that's great verification. I made a right decision. It's great. But we are so caught up on the cash flow, we forget how many barrels of oil, how many miniature Exxons have I created with our 750 clients? As you continue to put acres in your portfolio, you're stacking 1,171 barrels of net barrels of oil equivalent for every acre acquired. You're putting 1,171 barrels in your pocket. Some of you now own 100, 200, 300 acres, 400 acres yourself. You now control 30, 40,000 barrels of oil you're not even aware of. Your safety deposit box is loaded and full of value of natural resources. I want you to know this is something I'm going to do, and I'm going to try to walk you through a sequence of presentation like this to help you really understand what drives Troy and what keeps me so motivated every day. It's all those barrels of oil being shoved into my bank account, knowing that I've got 30 or 40 years worth of reserves coming out with multiple tranches of development. But in the meantime, I'm real happy making 12 to 30% rate of return. I'm Troy Eckard with Eckard Land and Acquisition. I hope this helped. Please ask any questions following this video up, but wait and see what video 2, 3, 4, and 5 do. You might have all your questions answered for you. Thanks again.